What's up, investing legends? Today we welcome Tom Dunkel to the program. Tom's journey started in corporate finance, where he spent years working on mergers, acquisitions, and capital raises before starting a long entrepreneurial road through real estate, distressed mortgage notes, self-storage, and private lending, learning hard lessons, building real businesses, and raising lots of capital along the way. And today, Tom runs Gould Capital Investments, where he uses a fund of funds model to help investors access better real estate opportunities and stronger economics by pooling capital together to invest in trusted real estate operators. This morning, we kick off the episode with Tom's origin story and how his background in corporate finance shaped the way he thinks about deals, risk, and capital allocation. Later on, we dive into the fund of funds model, why most investors are far too concentrated in public markets, and how Tom evaluates sponsors before putting a single dollar to work. And to wrap up the episode, Tom shares his outlook on real estate in 2026, why he's bullish on housing, and the investing principles he believes matter most if you want to build real long-term wealth. So if you're looking for practical frameworks to diversify beyond Wall Street, think more clearly about risk, and invest alongside operators you can actually trust, this episode delivers perspective from someone who's been actively raising and deploying capital across multiple cycles. So without further ado, everyone, let's welcome to the show, Tom Dunkel.
Welcome to the Investing Secrets Podcast.
Tom, welcome to the vault.
Hey, Danny, it's great to be with you and all the listeners. Looking forward to our conversation today.
Yeah, man, I'm excited to jump in, and my God, you've got a lot of accolades here. You've been involved in a ton of things, but I gotta say, man, I was reviewing the cheat sheet that I got from Rochelle, and the most impressive thing about you is the 8 handicap. So can we just talk about that for a second? I'm like, dude, that's crazy. That's the most impressive thing. I was like, it's an impressive resume, but I got the 8 handicap. Yeah. I was like, whoa.
Yeah, no, I appreciate that. Luckily, I was lucky enough to grow up playing. So I've been pretty much playing my whole life. I was down to about a 5 at one point, but I tell you, to maintain a 5 or lower, it's like a job. Like the guys that I know that are scratch golfers, man, they have a whole routine during the week. It's they're practicing on Tuesdays and Thursdays, and they're playing on Wednesdays and Saturdays and Sunday. It's it's a lot of work, to keep that low handicap. So mine is, kind of drifting upwards these days, but, it's something that I love to do. I love being outside, love to, be out in nature, something my wife and I do together. So it's been a super great part of my life, forever.
Yeah. No, I can only imagine, because to get that good, it requires more than just a few, practice rounds. It's funny. I would say that my handicap, I've never measured it, but I imagine it's about an 80. So we're off by a factor of 10.
I hear you. Hey, you're not alone. If you can break 100, I've heard this stat, if you can break 100, you're better than 90% of the golfers out there. So,
yeah,
go out, have some fun, get a little walk in, enjoy the scenery. That's all with some buddies. So.
100%, man. 100%. I need to figure out how to make the ball go straight. If it only just went straight, I'd be good.
Yeah. I hear it. The other thing too, which I enjoy is, if there's a conference in Scottsdale or, Miami, someplace cool, I'm totally going, and, I get a little tax rate off there for, going out and taking some friends out to play golf. So just throwing that little tidbit out there. We'll be sprinkling some things throughout our conversation today, but, definitely don't go on vacations, always go on a conference or, a board meeting or whatever, you run those things through your LLC. This isn't tax advice, but just something you might want to look into as an entrepreneur. There's a way to go have some fun and like Robert Kiyosaki says, he wants you to have high income, but he also wants you to have high expenses. Run whatever expenses you legally can through your entity, and you certainly can legally, write off trips for conferences and golf outings and stuff like that. And so, just be careful. Don't go crazy with it. But,
we're going to call this section not tax tips by Tom.
That's right. Yes.
Not in parentheses, tax tips by Tom.
That's
I love
right.
it, man. Yeah, I definitely agree with that strategy. So be smart, and it's
so, you know, I'm based out of the Northeast, right? And it's been like under, 800 feet of snow so far this winter has been really bad. So I'm in South Carolina right now. I'm actually getting ready after this to go out and play a little golf because,
there we go.
I don't like to battle the winter anymore. But, again, if you orchestrate things the right way, you know, you can have, geographic freedom as well as, financial freedom.
So that's a really great segue into what got you to this point, man, because obviously, as I mentioned, your resume is impressive. You've got a fairly extensive track record in finance. And so, and now you run what is colloquially referred to as a fund of funds model, right? At Eagle Point.
That's right.
Or at Eagle Capital, I should say. So, talk to us a little bit about Eagle Capital, and then let's talk first about that. Then I want to go back in time and get kind of the backstory that led you to this point. But I want to first hear a little bit more about what you're working on at Eagle.
Sure. Yeah, Danny. Eagle Capital Investments is my latest venture. And it's a fund of funds, which, basically means, I'm aggregating capital from my investor network that I've developed over, the past 20 years doing this, raised $50 million of private capital. And so I'm taking that capital and I'm deploying it into, other people's deals, syndicators that are doing multifamily deals or syndicators that are doing, self-storage deals. I can even place the money in another fund. So I have different operators and different fund managers out there who I've gotten to know, like, and trust, throughout my journey. And so, that's such a huge, hurdle to overcome because, I see too many investors out there just placing capital with people they don't really know or understand, kind of where they're coming from or their business model, that sort of thing. We can get more into all that. I have a whole proprietary, due diligence method that I share with my investor community to help them make good decisions and try to de-risk things. But in a nutshell, that's what Eagle Capital Investments is. And, so, to be honest, and we talked a little bit about this before we hit record, but it's really a way for me to sort of ride off into the sunset a little bit because I've been an operator in self-storage and, distressed mortgage notes and all this stuff. I've been banging around in this crazy entrepreneurial, real estate world for about 20 years. And, so now through Eagle Capital Investments as a fund manager, I'm able to kind of just play more of a limited partner role in the world. And, I'm basically looking for deals for myself. And if I find a deal or one of my friends who I've known for a while, he's like, hey, I've got another multifamily deal out in Phoenix. I'll go through my due diligence and, check out the numbers. That's really my training. I'm a financial analyst by training. And if it's a good deal, I'll throw my money in, but I'll also put it out to my investor network and say, hey, I've known this guy for X number of years. They've got this great business model doing multifamily in Phoenix. If you want to throw in some money, if we aggregate our dollars, we can actually get to a higher level of economics with that operator. And what I mean by that is, I could go to them by myself and just be like a $50 or $100 or $200,000 investor. And for that, just to illustrate, I might get like a 7% pref and like a 70-30 split of the profit, right? Which, probably get me into like a mid-teens kind of return overall is usually how those things are geared.
Yep.
But if we aggregate dollars together and we go to them as one investor with $1 million, say, then, my friend is more than happy to pay us an 8% preferred return and an 80-20 split of the profit, which is going to get us, into the higher teens and maybe, 20 kind of percent return. And so that's sort of the magic of just being a fund of funds and aggregating more dollars and placing those with trusted operators.
Yeah. I love how simply you broke that down, made it very easy to understand, which I appreciate because it's a complicated model, or it's really not that complicated, but people can tend to overcomplicate it. Yeah. Totally.
Yeah.
Yeah.
I mean, especially if you're, into stocks, bonds, and mutual funds, or you've got you got a high level, W-2 type of job, and you're just stuffing your 401k or whatever. You don't really know what's in it. It is a little different. It's a little different, but it's effective. And what I encourage investors to do is when you're starting out, 100% stocks, bonds, mutual funds, get that going, be diversified. But for true diversification and true wealth building, you need to, at a certain point, of your wealth building journey, you'd have to start adding in, the alternative, what they call alternative investments, which, side note, that term drives me absolutely freaking nuts. I hate that term because let's be honest. How long has, real estate and lending and, gold? I mean, this stuff has been around since the beginning of time, right? It's the stock market that's the derivative new, concoction. So anyway, sorry, I won't get up on my soapbox on that one, but that's how I feel about it.
Alternatives it's a very broad word. And when you start really diving into the world of finance, you recognize that what they mean by alternatives is alternative to Wall Street, which is hilarious because Wall Street has basically cemented themselves as mainstream, as the go-to. And, crazy stat, Tom, and I'm sure that if you don't know the exact stat, I'm sure that you're at least aware that this is true, which is the average American has over 95% of their investable assets in public equities. Yeah. The average American.
Yeah, I believe it. And, Wall Street has done a brilliant job of advertising and, advertising, you can't swing a dead cat without hitting like a stadium that's named after a financial services firm, or, when you're watching golf on TV, there's always a Charles Schwab commercial, whatever. And they make it so easy, right? Like you can go on your smartphone right now and go to schwab.com and click, buy whatever stock you wanted. And that is one of the things that is a hurdle for sure when you're starting to get into, more, private types of investments. And to me, it's worth the effort. And to me, it's one of those classic who, not how situations, right, Danny? So like, if you're like, hey, I'm excelling in my career. I've built up some wealth. I've got this stock portfolio. I'm going to do the smart thing and start adding in some alternative investments. Next question should not be, how do I do that? The next question should be, who can I reach out to that can help me get along in that world? Because there are things you got to know and need to understand, syndications and waterfalls and tax implication, and all that stuff. So that's again where I think Eagle comes in, and where, I have this trusted, group of investors who I'm very grateful, for. They trust me with their hard-earned money, and it's because I've been at this 20 years and I know the pitfalls to look out for and the red flags and this and that. And so I think it's definitely a who situation, not a how situation.
Well, I love that. And it's rare, I think, Tom, to have someone that you can trust, and bounce financial ideas off of. I mean, let's be real, right? Like, most people don't even trust their financial advisor.
That's right.
Yeah. Or if they do, they shouldn't.
That's right. Yeah, that's right.
They either don't trust them, or if they do, they really shouldn't. Don't get me wrong. There's one of my best friends, Brandon, is a financial advisor at Merrill Lynch, and I've got my stuff with him. But look, I mean, for every one of him, there's about 100, 150 or so that have no idea what the hell they're doing. And And, Warren Buffett said, Wall Street's the only place where someone will show up in a Bentley to take financial advice from someone who came into work in a Subway.
Right. Yeah,
I'm going to roll up in my Bentley to take financial advice from someone who came to work in the Subway.
And the other thing with those guys too, Danny, and look, I'm a financial advisor, we've been together a long time. But if you go to your financial advisor and you say, I heard this podcast the other day and I think I'm ready to diversify into real estate, they'll say, oh yeah, we got you covered. Here are these real estate investment trusts over here. And just say, oh, okay. That's not investing in real estate. That's investing in, a derivative of real estate. Right. Where you're still correlated with the overall market. And, and that's not what you're trying to do by expanding your portfolio into real estate and other alternative investments. You're trying to get away from that so that you can be truly diversified. So when a tsunami hits Japan, and this happened, I forget the date, the year, but I remember when it happened, a tsunami hit Japan and the U.S. stock market went down. How does that make any sense?
Doesn't make sense. Right.
If a tsunami hits Japan today, it's not going to affect the returns of the self-storage facility that I'm invested in North Carolina. It's just not.
Yeah.
That's diversification.
Yeah. No, I couldn't agree more. And to that point, I mean, we'll throw you in a REIT or, we've got the special access to a Blackstone fund, right? It's and people, Blackstone, right? But it's like, dude, you're clipping an 8% coupon.
That's right.
What are we doing?
That's right.
Right.
Yeah. And that's the other brilliant thing that Wall Street has done, is they've convinced us that 10% is like an amazing return. Right. And 10% is a good return. If you do 10%, with safety and lack of volatility over a long period of time, yes, you can definitely build wealth that way. But I mean, 10%, for the people that I have as investors and myself and my family, that's like the floor, man.
Right.
I have lending, I'm a big fan of private lending and my private lending deals, where I'm in first position secured by a house, I'm making, well over 10% on those deals. And, I get checks every month. And so but again, I've been at it a long time. I know these little avenues and, secrets, right? Whereas the financial advisor, they're not incentivized to kind of help you get into these other things. Their incentive structure is totally different. And, I have a friend who flat out told me, good dude, great golfer. He runs, a typical wealth management type company. And I was talking to him about the deals that I was seeing and doing and how great they would be for his investors. And he's like, why would I take my investors' money out of my company where that's how I make my fees and stuff and give it to you? Right. How does that even, make any sense? And, there are probably ways to do these separate accounts and whatever gymnastics to make it work. But at a high level, it's just the incentives just don't align there. And again, that's why I invest in every deal that I do through Eagle Capital Investments, because that way our interests are very much aligned. And do I clip a little fee? Of course I do. I'm a capitalist, but I'm providing a valuable service. So that spread that we create by bringing more money, I clip a little fee there, but nothing outrageous. And I think it's more than worthwhile and more than fair. And my investors still get a higher rate of return than if they were to go to the operator with their $50,000 or $100,000 just directly. So they make more than they would. And, I make a little more too, and everybody's happy.
A true fund of fund, the best fund of fund structures are the ones where everyone wins.
100%.
The investor wins because they're getting access to economics that they wouldn't get access to otherwise. You win. The fund of funds manager wins because obviously they're organizing, so they're going to be able to create a little bit of a spread for themselves. And even the sponsor of the deal should win because they're able to raise more money in less time and have to deal with less investors. So their overhead and their operational oversight and everything is lower. So it's a win-win-win situation. And if it's done the way it should be done, right? If everything goes according to plan.
That's good explanation.
I also would say, and I don't want to beat this over the head, Tom, but we're down this avenue here, and I feel so. The other thing is I do feel that there is a true lack of understanding, right? Of the world that we're in, of the alternative investment world. So, I think what Wall Street has done a really good job of is convincing Americans that they understand Wall Street. Like Wall Street's something that you understand, but really you don't. There's nothing that, like, you're telling me you understand what Coca-Cola and General Motors, like, you understand their business plan and what they're doing. Like, no, like all these companies that you're investing into, you actually don't understand their business at all. So the idea that we don't understand alternatives, you're right. You also don't understand General Motors. You don't understand Coca-Cola, Apple, Amazon. You don't understand any of these companies.
No. Right. No, you're exactly right. And here's a little, we talked about, maybe talk a little bit about my history, but before I got into my entrepreneurial career, I actually worked for publicly traded companies, in their financial, world. And I can tell you that the financial statements that they put out, and this isn't just the companies I work for, it's just a universal thing across the board, that by the time their quarterly report comes out and is published to the public, that information is stale, right? So, and if I'm remembering correctly, it's like you get a month and a half or something to file your quarterly report. So, the quarter ends March 31st, you're not seeing that information until May as a small time investor, right? But guess who has access to that information way before you? The Blackstones, the big companies, they have these inside tracks where they can get that information. Yep. And then the annual, they have 3 months to get that out. So, that information is stale, number one. Number two, what they call the management discussion and analysis section in those documents. Sorry, I'm nerding out here a little bit. But this used to be my world. Like, that's where the company writes a narrative discussing like what happened in that time period, that quarter or that year or whatever. And that management discussion analysis is just a spin job, man. Like they are able to word salad this stuff to make even like a crappy quarter like sound pretty good. And they have to color within the lines to a certain extent because the SEC is looking at that and it has to make sense. And and they do have an obligation to clearly communicate with their investors and whatnot. But I tell you, they kind of straddle that line sometimes, and it makes it really hard as an investor, as a small time investor, to really understand what's happening in that company so that you can make an educated trade in that stock. It's kind of ludicrous, if you ask me.
So I want to kind of go back in time because you've referenced it now. So, walk us through the journey that kind of got us to this point. I mean, you mentioned you were operator. I know that you did some M&A work and capital advisory. So, want to understand the timeline here.
Yeah. So I was one of those annoying, business school MBA guys. So I, got out of there, had a great education, and, I landed this sweet, job in, doing mergers and acquisitions in the aerospace industry. So I was a financial analyst, and, I was building all these, financial models to, look at the combined companies and build the projections and, come up with all the assumptions. And that work that I did was used to then go out and raise the capital, the debt and the equity to close those deals. And these were, $20 million, $50 million deals. I think our biggest acquisition was like $120 million. And so I did that for a while. And that was amazing. I mean, I was around some incredible people, in the aerospace industry. I mean, you have ex-fighter pilots. You've got, my one boss actually was a Gold Glove boxer at the Naval Academy, went and did his tour of the Marines, went and got his MBA at Wharton, and then, became, this corporate development guy at this aerospace company. And he was awesome. But the caliber of people at this company was just off the charts. And, astronauts, I mean, it's crazy. So I had this great foundation, and I was really learning, the nuts and bolts, hardcore, Excel spreadsheet, nerding out, type stuff. But it was, really putting deals together. And then, I left that company, bounced around a little bit, but I was still doing that sort of work. And, during that time period, did over $1 billion, $1.2 billion worth of deals. And so by the time I got fired from my corporate finance job in 2006, I had already kind of had it with corporate America. And that was, the kick in the pants that I needed to actually go out and start my entrepreneurial career. Cause let's face it, it's kind of hard to make that leap. At the time I had a, wife, a 4-year-old and a 2-year-old at home. And, it's like, when do you make that shift? It's a hard call, but my call was made for me. When my boss was like, Tom, yeah, we need to talk. And I was like, all right, see ya, I'm out of here. But that was 2006, Danny, right? So.
Right.
2006 probably was not the best time to get into real estate, but I did it anyway. And, so learned some hard lessons over those next few years. Cause here, I thought I was a hot shot, with the background that I had, MBA, worked for some great companies. Yeah. I had some great experience. I was like, this is going to be great. There's no problem. I can do deals. But, learned some hard lessons those next few years about, really what it takes to build a team. And cause I went into real estate, I was doing wholesaling and fix and flips and picked up some rental properties and that sort of thing. And, when you're doing that, to that point, the only house I had ever bought was the one I lived in with my family.
Right.
So, it was definitely challenging, but, persisted, was not going back to corporate America. The boats were burned. And, then I found distressed mortgage notes, built a company there with my partner, Joe. That business is still alive and well today. We're, I think, over $65 million worth of revenue the last 15 years, which is pretty cool. And that's allowed us, the success of that business has allowed us to do some other things. So we have a self-storage portfolio. We have a short-term rental portfolio. And we've dabbled with different things here and there. Most of those kind of fizzled out and failed. Title company, hard money lending broker, that sort of thing. But we do today have, the distressed mortgage debt business, the short-term rental portfolio, and self-storage are sort of our things that remain there. And that's all being run by the team, which has given me the freedom to go out and do the Eagle Capital stuff.
That's awesome, man. Yeah. And obviously all of those businesses required you to raise money. So you had that foundation and the ability and the network, and the skills to go out and raise the money, which is the thing that a lot of well, first of all, no one ever came to work and said, we have too much money today. Right. Like, no, there's no, that just doesn't exist. Right. So, there's always more deals. There's always more money that's needed. And so your skill set lends itself very nicely to the needs of operators out there who either, need more money to do the projects that they want to do, or have enough money, but would like to have more so that they can go out and do more projects. Right. And that's where you fit in. So I guess my follow-up question, to that is, what are the things that you look for in the operators that you select to invest into, right? What are the key attributes of the operators? Because I assume, like most fund-to-fund managers, right, we're much more focused on the sponsor than we are the deal. Because the deals come and go, but we want to make sure that we're getting into bed with the right people, because the right people will choose the right deal. Right. It's what most people, it's like, oh, we choose a deal. No. Deals are a dime dozen. The secret sauce is the sponsor.
No, you're spot on. And that's why in our due diligence method that, my partner Joe and I have developed over all these years, just, being on the street, we call it the SAFE method. And, investing isn't safe, so don't come to me later and say, oh, Dunkel said investing was safe. No, it's an acronym. It's an acronym, SAFE, and S stands for sponsor, and that is always where you have to start. And then after that, you get in the deal, you get in the assets, the financials, and the exit. But you have to spend a good chunk of time on that S sponsor portion of your due diligence. For exactly what you just said, the right sponsor is going to pick the right deal. And, this became apparent to us too when we were raising money and doing our building up our distressed mortgage debt business. We were able to attract a 9-figure net worth guy, and of course he needed to feel us out at first, but once we did a couple deals and he saw how we operated and that we were very transparent, very very fair, very skilled, he paid us a great compliment, which was, okay, I trust you guys now, so bring me whatever deal you want later. I might do it, I might not do it. But he said for him, having that relationship and that trust that was built up, it's like it allows him to sleep well at night, so that the deal may or may not work out, but he knows that if it does or doesn't work out, it's not because we were, ripping him off or doing something stupid. Right.
Right.
So we have that same kind of approach when we're placing money with another operator. So, I will tell you, for me personally, like I won't place capital with an operator that I haven't met with in person, like knee to knee, breaking bread, maybe having a bourbon. I don't know. Beer,
there we go.
Myself. Play around a golf with them. That's, really get to know somebody that way. But, and it's never like, it's never like an instant kind of things, for me. So like if I've met somebody like at a conference, or maybe we're in a mastermind together or something like that, it's like, that's the beginning of the relationship. That's the beginning of the vetting process. And a lot of times too, they'll come to me and say, hey, I've got this opportunity I'm looking at, would you be interested? And I'll say, I tell you what, I'm not going to invest in this first deal, but what I'll do is I'll go through the motions as if I am going to invest. And so that way I can, go through my due diligence process, see how you put your numbers together, see how you rationalize your assumptions, see, learn about your team, your process, your this, your that. And then, it'll be like a mock run through, right? A dry run through a deal of theirs. And then, I'll see how the deal progresses and that sort of thing. So that way, when the next one comes up, if they've performed with integrity, and even if the deal isn't like a home run, as long as they're, communicating well, they're under promising and over delivering. I mean, that's the ideal scenario, right?
Of course.
Then on the next deal, I'll take a look to actually, deploy some capital. But it's not an overnight thing. It's not hey, I got an email or I saw someone on a podcast and
yep.
Funny side story. Dan, if you'll indulge me for a second.
Yeah.
I've probably been a guest on, I don't know, over 100 podcasts at this point. I think it's fun, and honestly, it generates some decent, investor activity for me. But I did back when I was an operator just doing self-storage, we raised about 20 something million for our self-storage venture. I was on a podcast, and of course, the podcast is recorded. It comes out later, right? So, I'm in the office one day, and this wire transfer for $100,000 just hits our account. We're like, we had no idea where it came from. Then we look at our investor portal, and someone had just heard me on a podcast. They came into our investor portal, signed up for this deal, and wired $100,000 without talking to any of us. Now, look, if you're in our business, I mean, that's really cool, right? I mean, it's kind of, it says a lot about, but for the investor, it's like, don't do that.
What are you doing, dude?
You don't do that. I mean, I see some successful doctor out in California, and I guess has, some money to throw around. But even so, like, that's your starting point. Start with the podcast, start with the meeting them at a conference, start with that. And then, get to know them through a deal. But yeah, don't just listen to me on this podcast and then shoot me $100,000 later. I mean, I don't know.
Or do. I mean,
or do it.
I don't know. No, that's really funny, man. I don't think I've ever heard that before. I mean, gosh. Yeah. Well, actually that's not true. There was a gal that I had on this show, by the name of Sarah, and she runs a very, very successful, multifamily syndication, group. And she does a ton of webinars, but based off of my conversation with her, and I don't want to misspeak and say something that's not true, but so preface this by saying I think this is true, but I'm not 100% sure, where she says, because her background is in corporate, she was with several larger corporations that, larger corporations now, they don't have, you can't even talk to somebody on the phone anymore, right? It's all automated. Right. And so she kind of applied that same infrastructure to her capital raising business. And apparently most of the investors they do the webinars with, but it's all self-serve after the webinar. And you just kind of go through and they subscribe and go through the PPM and do everything without ever really having it. So they don't really have an investor relations team. Their investor relations team is all automated. And I was like, man, talk about running a lean business, and great. I mean, it's cool that it works for her. I'm more like a people. I feel like, it's a double-edged sword, right? Because you can build more trust that way for sure. But I feel like sometimes people talk themselves out of deals too. So, you can, it's like, okay, you want to talk, but not over talk. But I also feel like the retention, Tom's retention long term probably goes up significantly when you have those initial conversations, right? As opposed to just allowing them to self-serve themselves through the subscription process, right? So interesting philosophy.
Yeah, and automation is great. And, we use automation. We have for years. And, but for me personally, when I'm on the other side of the table and I'm on the investor side of the table, I'm definitely, taking my time and wanting a little bit more of that personal touch, a little more love. But yeah, for me, it makes it, feel more comfortable. And again, as a financial analyst and, having done lots of deals in lots of different places, I try to, just make sure the stories are consistent. The numbers line up with the story and that sort of thing. So to me, that takes time and, to really develop that level of trust. But that's what it's all about, is building that trust. If you can do it through a webinar or, through an AI agent, like on my screen here, tomdunkel.ai, you can go there and talk to my clone.
That's
my
cool.
AI clone if you want.
There you go. I love that.
Or, I could get on the phone with you to talk through, but for me, it is a trust game. I mean, we're talking about people's hard-earned money, and it's a huge responsibility. It's very,
right.
very important. So, it's one thing if I lose some of my own money, but losing other people's money, which I've done, unfortunately, it's been bad, keeps you up at night, but, run into some tough situations. And if you're in this game long enough, you're going to run into tough situations. And, and that's when, the trust and the transparency and the communication is really important. And, it's going to happen at some point, I would guess. But, it's all about that trust factor, the communication, the transparency, the availability, right? Being able to, like we were talking earlier, you can't pick up the phone and call Tim Cook at Apple and say, "Hey, how are things going?"
Right.
But for my deals that I do with my network of operators, it's like, "Hey, Bryce, hey, Tyler, hey, Hunter, hey, Corey, like, what's going on?" Like, I can call them right now. And that they are in charge. They are responsible. They're running the show, and I can have a direct conversation with them, whenever I want. So
that's awesome, man. Well, we are running up on time, Tom. So, we want to, get you out of here on time. But before we do that, a couple things. Yeah. You mentioned the tomdunkel.ai. People want to learn more about how to work with you. Is that where they should start or somewhere else?
Yeah, sure. I mean, tomdunkel.ai is a fun place to start. It's my voice and everything. It's kind of fun. But, that's cool. I would also encourage people to go to investwitheagle.com, investwitheagle.com. That's where, you can, get a free copy of my book, the Wealth Builders Playbook. And then that just kind of gets you started in our world. And that's where I share, exclusive information with our inner circle and that sort of thing about what I'm seeing in the marketplace, what I'm seeing in the economy, how I'm feeling about things. And then, of course, any deal that I'm looking at putting capital in, that's where you do that too. So that's investwitheagle.com.
Love that, man. Well, couple things here before we wrap up, Tom. First one is 30-second Spark Notes forecast for 2026. What do you think we're going to see here in the real estate sector here for the year?
Yeah, I think it's going to be a good year for real estate. I mean, we're recording this here, kind of late February, but I just saw the headline today. Mortgage rates dropped below 6% for this first time in a long time. I think residential is going to be great. And let's face it, housing is critically important. People need a roof over their heads. So I like all the housing sectors, multifamily. I'm a big fan of mobile home parks. I touched on that earlier. I haven't personally invested there yet. But I've been analyzing it, and I've got a couple operators who I know, like, and trust in that world. And, to me, that's a real, answer to the housing affordability crisis in our country is mobile home parks.
Interesting. Yeah. I definitely know a few mobile home operators that are very bullish. And then I know several who aren't, but I think it really depends on the acquisition strategy, where you're buying, et cetera. Yeah, man, that's fascinating and an interesting perspective. I'm not going to let you leave the vault though, Tom. We in traditional, Investing Secrets podcast, fashion, we're going to have you leave the audience with one final investing secret. Take it away.
Oh, wow. One final investing secret. It's going to be boring. Sorry, but don't lose money. When you lose money, that kills the compounding of your wealth. And that's really what we're trying to do. So, when you're young and full of hope and you do have a long runway ahead of you, right? So you can take more risks and do some crazy stuff. But if I had it to do over again, I would have throttled that back a little more, to be honest. I would have been more conservative, I think. And it's just math. Sorry, it's nerdy and it's kind of boring, but it's the truth. It is that, when you lose money, you lose 100%. Let's say a deal goes bad, you lose your investment. That is incredibly challenging to recover from later. And even they talk about the example where, if a stock goes down 50% or whatever it is, your investment goes down 50%. Now it needs to go up by 100% to get you back just to break even. So, if I had it to do over again, I would be more conservative. And I would definitely, and along those lines, we've touched on it many times today, Danny, is make sure you vetted your sponsor. They've got the track record. They've got the team. They've got the experience so that you don't lose money. And it, Warren Buffett's been saying it, for forever. Rule number 1, don't lose money. Rule number 2, don't forget about rule number 1.
Yeah.
So sorry, it's not sexy or glamorous or exciting, but that's where I'm at.
Yeah. I would say that, the question I ask all my investors is, do you want to be sexy or do you want to be rich? So most of the things that make you rich aren't very sexy, man. So,
capital preservation and cash flow are like the two main things I look for in deals these days.
Love it, man. Well,
growth is a nice to have.
It is. It really is. And it's obviously younger folks who have a little bit more risk tolerance, strategically, making some bets along the way. Fine. But I couldn't agree more. As I've become more and more immersed in this world, call it over like the last 5-ish years or so, the more evident it's become to me that the best way to build a foundation is through cash flow, right? Is through investments that provide cash flow that pay for your lifestyle. And then beyond that, do whatever you want to do. But the foundational piece should be, like, as you said, like capital preservation. I think that goes without saying, but also a investment foundation that provides you enough cash flow to live off of. And then after that, like life becomes so much easier. It's just, just like, yeah, I don't need to work anymore, which is nice. And then the work becomes the gravy on top, and then it just compounds, right? Like at that point you're humming. So yeah, man, love it. Couldn't agree more.
I think unfortunately our financial education system, if you could even call it that, we don't really have much of one. I think it's upside down. I think you focus on cash flow and capital preservation initially until you get to that financial freedom place. Here's a perfect example of that. And I know we're running long, but this will be a tasty little morsel for the listeners out there to leave with. But, there's a woman I met years ago, when I was running a meetup group, for investors. And, she said, and she was, at the time, maybe mid 30s, maybe getting close to 40. She's, maybe 40ish, something like that. She was financially free. She had income coming in from her investments that were greater than her monthly expenses. Mm-hmm. Now, that's super awesome and super cool. But here's what it allowed her to do. Her career was as a healthcare consultant. And because she was financially free, when she was negotiating a contract with a client and they said, oh, well, we're not going to pay you that. They tried to negotiate her down. She'd be like, all right, I'm out of here. See ya.
Yeah. Fuck off.
Because how powerful is that? That 100%. Is incredibly powerful. Can you imagine that? Like because I didn't reach financial freedom until much later in life, but if you're in that situation, like, man, it gives you so much power to direct and dictate the trajectory of your life. It's like,
100%.
when I heard that, I was like, oh man, how cool would that be where you are really calling the shots. You have all the negotiating leverage.
Yeah.
And guess what? Her client would be like, okay. And they'd sign whatever she wanted.
Yeah. No, I couldn't agree more, man. I could not agree more.
Awesome.
I think it's, having that foundational, that foundation, just makes you way more dangerous, right? It makes you way, way more dangerous. So
yeah. And then there's build from there.
Well, I'm glad that we were able to end on that. And, yeah, man, can't wait to see you continue to succeed. And who knows, maybe we'll have you on again.
Yeah. Thanks, Dave. It's been a lot of fun, buddy.
All right, man.